West Texas stacker asked a really interesting question. And so I said I was going to answer it, and here it is. But first, we'll start with the question. My only question I've had for a long time now. We all know the dollar is weak, but it would seem like stackers would love a total collapse of the dollar. It wouldn't be good for anyone, even if you have silver and gold, which is absolutely true. He further goes on to say, this gal is pretty savvy, just not buying into the doom and gloom of the dollar to get people to stack precious metals. Well, frankly, that's a really fair question. And in fact, it's exactly the question that I love to get asked. But before we answer it, I want to ask you a different question. Do gold and silver investors actually want a dollar collapse? Most people assume the answer is yes. But I think that's because they're looking at gold and silver through the wrong lens. So let me ask you something else. Do people who buy homeowners insurance want their house to burn down? Of course not. Nobody buys insurance hoping disaster strikes. They buy insurance because disaster is possible. Insurance isn't a bet. Insurance is preparation. And that's exactly how I view gold and silver. Now, let's take that idea one step further. Because when you buy homeowners insurance, your premium is spent. It's gone. You send the insurance company your premium, it's gone. You hope you never need to collect on the insurance. But that's the only way you might see some of payback from those premiums or of those premiums. Most financial assets work the same way. It's all fee-based, you pay it, and it's gone. You're trusting a contract, a promise, a liability issued by someone else. Now, my friends, that is counterparty risk. That promise works beautifully until it doesn't. So what kind of insurance has not only survived every monetary system for thousands of years, and that does actually not cost you that fiat money premium? Shocking. Gold and silver. They have survived every single monetary experiment, every empire, every government, every currency reset, and they've done it for thousands and thousands of years. Not because governments say so, because they sure don't. It creates restrictions. But because global markets do. Since, let's frank, I show you all the time that they are used, both physical silver and physical gold is used in every single sector of the global economy. Therefore, they have the most diversified demand. So if demand over here goes down, it rises over here. Gold and silver do not require trust in an issuer and are, frankly, according to the Bank for International Settlements, the central banker's central bank, the only financial asset, the only one that runs no counterparty risk. Unlike those insurance contracts or even, I don't know, how about the debt dollars? Give it any fiat money name you want. The chart I'm about to show you reflects a pattern that has repeated throughout history. First, there's sound money, but governments want to tax without legislation and corporations want to pay workers less. So in this case, a new system is born. That's how it works. Now let's look at why monetary insurance actually might matter. Because after they do that, a new fiat money system is created. Then debt expands. And finally, the system transitions into something new. And as all of that is happening, purchasing power declines by design. So while I'm not predicting tomorrow, I am simply observing a typical historical pattern. And what does that pattern actually look like in real life? Well, let me show you. Because since 1913, the purchasing power of the dollar has steadily declined, and now officially it is less than 3 cents. But at the same time, the spot gold contract has moved in the opposite direction. One measures the loss of purchasing power. The other reflects the market's attempt to preserve it. So you see, gold isn't making you rich. It's not about that. It's about helping prevent you from becoming poor. But something changed that most people completely missed because something fundamental was happening beneath the surface. And the monetary system was entering a different phase. So beginning around 2002, the relationship between the spot dollar and the spot gold contracts changed. I came into the metals markets in earnest. Actually, it was June 28th of 2002. And it's because of this change. What you're looking at is a relative performance chart between spot gold and spot dollar. Notice that up until 2002, generally, they were opposite each other, right? So if the dollar went up, spot gold went down, and vice versa. Right? And whenever you look at something on a short-term basis, you can see one particular pattern. But let me explain what I mean by something really major that shifted in 2002, because here it is. This is a longer-term relative performance chart showing spot gold, spot silver, and spot dollars. Can you see how far apart that divergence that they are now? Well, that tells me that the underlying monetary stresses have not been resolved and are frankly getting worse. And to understand why, we need to understand where liquidity actually sits. Because most people think that money sits at the top of the financial system. It doesn't. The world is built on layers of promises, contracts, debt instruments, derivatives, and leverage. Real money, down at the very bottom, is a very small foundation underneath an enormous pyramid of claims, an enormous amount of just promises and bets. And as long as confidence remains high, well, guess what? The system functions just fine. But when confidence falls, now you got a different issue because people begin moving from promises to real assets. And you might recall that that transition began in January of 2025. And this is what happens when confidence starts leaving paper assets. People stop asking, how much can I make? Which is what they're asking right now, right? To the moon. And they start asking, will I get my money back? And that's when synthetic liquidity begins to disappear. Capital moves towards tangible assets. Historically, that includes gold and silver, not because investors want collapse, because they want protection. So let's return to that original question. Do gold and silver investors want a dollar collapse? The answer is no. I don't want a dollar collapse. I don't want a banking crisis. And I certainly don't want businesses to fail, and I absolutely don't want people to be hungry or hopeless. Do you? No, of course you don't. But wanting something and preparing for something, two very different things. History shows that monetary systems change, and it shows that purchasing power shifts, and it also shows that confidence rises and falls. So the question isn't whether you believe me, And frankly, the question isn't whether you agree with me. The question is, do you own the money that survives the change? So if this presentation makes you think a little differently about gold, silver, and monetary insurance, please share it with someone who needs to hear it. And if you'd like help building your own strategy, reach out to our team. Because preparation is always easier before the storm than during it. And I know that together we can make a positive difference for a lot of people. All we have to do is get 3% of the population to convert their garbage fiat into sound money. And we have a shot of getting real sound money that is above government's ability to inflate away back into the system again. And until next we meet, please be safe out there. Bye-bye.